Investing in the stock market can be pretty complex, especially for young adults who have a single dollar in their pocket. But when things are done right, you can gradually turn a single dollar into $2, and well, that's more than what you had yesterday. While the stock market is often perceived as something that devours inexperienced investors and favors the seasoned ones, the concept behind it is actually quite simple. Making money off of it is easier than you think, especially when you know what you're doing. Hey, welcome to Stock Market Mate. Today, we'll talk about the basics of the stock market and how it works. But before we start the video, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. So what is the stock market? The stock market is basically letting buyers and sellers negotiate prices and make trades. However, in order to understand the stock market better, we need to first discuss what a stock is. Defining a stock. A stock or equity is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stock they own. Units of stocks are called shares. For example, let's say Amazon has 1,000 shares and you purchased one share. This means that you own 1 of 1,000th of Amazon. In reality though, companies like Amazon have millions of shares, but you get the point. When you buy a company's stock, you're simply buying a small portion of that company. As the company's value increases, so does the stock price. There are two main types of stock, common and preferred. The main difference between the two is that common shares usually contain voting rights. That allows the common shareholder to have a say in corporate meetings like the annual general meeting of AGM, where matters such as election to the board of directors or appointment of auditors are voted upon. On the other hand, preferred shares generally do not have voting rights. Preferred shares are so named because preferred shareholders have priority over common shareholders to receive dividends as well as assets in the event of a liquidation. Why companies sell stocks? You must be wondering, why do companies sell stocks to begin with? This is quite simple. They do this to give money. Stocks enable a company to build a significant amount of operating capital without the need to exert much effort or use any products. The value of a certain company is often based on its potential earnings. This means that no matter how big or small a company is, it can still earn millions if investors see a successful future for it. Naturally, to sell something, you need a place to do it, and this is where the stock market comes in. Historically, stock trades likely took place in a physical marketplace. These days, the stock market works electronically, through the internet and online stockbrokers. Each trade happens on a stock-by-stock basis, but overall prices often move in a tandem because of news, political events, economic reports, and other factors. How companies list shares of their stocks. When a company establishes itself, it will require access to huge sums of capital that it can get from ongoing operations or a traditional bank loan. They achieve this by selling shares to the public through an initial public offering or an IPO. When this happens, the company transitions from a private firm whose shares are held by a few shareholders to a publicly traded company whose shares will be held by multiple members of the general public. The IPO also enables pioneering investors in the company to have the opportunity to cash out part of their stake, often reaping very handsome rewards in the process. When the company's shares are listed on a stock exchange and trading in it begins, the price of these shares increases as investors and traders assess and reassess their intrinsic value. There are various ratios and metrics that can be utilized to value stocks, of which the single most popular measure is probably the price-to-earnings or PE ratio. This is where beginner investors get intimidated, but don't fret too much about it. Stock market volatility. You already know all types of investments have their fair share of risks, and the stock market isn't an exception. However, with the correct strategies, you can potentially have lower risks and losses. Day trading, which requires rapidly buying and selling stocks based on price swings, is very risky. Conversely, investing in the stock market for long term has proven to be a great way to build wealth over time. Sometimes, the stock market could end down significantly while others rise tremendously. These massive swings are caused by market volatility, or periods when stock prices rise and deplete unexpectedly. If you're an investor who actively buys and sells stocks, you should expect the possibility of you getting it wrong at some point. Maybe you'll buy or sell stock at the wrong time and it'll result in a loss. The best way to invest safely is to stay invested even through the ups and the downs, and even in low-cost index funds that track the whole market, so that your returns might reflect on the historical average. Law of supply and demand. The theory of supply and demand is one of the most basic economic laws that's tied to the stock market. In fact, it is actually involved in all economic principles. Of course, there are certain factors that affect the demand of stocks, and this includes economic data, interest rates, and corporate results. So for every stock purchase, there needs to be a buyer and a seller. The people's willingness to supply and demand goods are the determining factors for the market equilibrium price. Simply, if there are more buyers, then the price would increase, and if there are more sellers, the price would go down accordingly. If you're into the stock market, then you will probably encounter the term bid-ask spread. This is when the amount by which the ask price exceeds the bid price for a share in the market. The concept behind supply and demand is simple. If more people want a certain stock, then the said stock will become more expensive. Back when the stock market was first established, matching buyers to sellers were done manually by utilizing a trading floor. In the current time, technology has been proven handy and the work is done automatically by trading systems. By this, the market moves at full tilt, allowing it to create a commendable pace for all its users. Matching the orders of the buyers to the sellers is done by specialists and market makers in the exchanges. When fitting buy orders and sell orders are submitted with the right price and right time, the matches take place. Quite simply, a buy order and a sell order are compatible if the maximum price of the buy order complements or surpasses the minimum price of the sell order. From there, the computerized order matching systems of different exchanges use a variety of methods to prioritize orders for matching. So should you invest in the stock market? Now that we're closer to the end of the video, some of you might still be puzzled with how the stock market works. You must be thinking, why should I invest in the stock market if I could just start a business or keep my money in a bank? Well, the response to that is not as complex as you think. Once you invest in the stock market and you do it right, then you can make a lot of money. Take this as an example. If you bought an Amazon stock in 1997, then you'd have $1.5 million today. Indeed, that involves a long investment timeline, but you don't really have to do much work with it. Now, if you choose to start a business, then you'll have to come up with a capital, which is usually the biggest hurdle. Put in the government fees, monthly operational expenses, equipment, and other assets, then you've got yourself a lot to think about. You might also run the risk of getting bankrupt. If you choose to save your money in the bank, you're a bit safer in times of volatility and there are obviously lesser risks. But returns are quite low and you might lose purchasing power over time, as inflation slowly consumes your money. In essence, as long as you build more than 3% in the stock market, then your money is doing better compared to when it's sitting in a bank. Investing in the stock market will bring the most wealth accumulated over the long run. However, it all boils down to preference on where you want your money to go. But remember that you should choose the smartest options that will bring the biggest returns. And that's about it for today's video. For more videos relating to stocks and investing, consider subscribing to our channel for more. Thanks for watching, and we'll see you on the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!